All right. Hello, everybody, and welcome back to another Pepperstone live event here on YouTube. We hope that you're ready for today's session because it's going to be a great one. Tyron and I are coming to you to talk about one of our favorite topics. And it's been a topic that we've often neglected, I think, recently, Ty, swing trading. So how are you going this week? And are you excited to get into this topic?
I am excited to get into this topic. Welcome, everyone. And look, I think it's one of those things that swing trading is sometimes it can be a little bit hard to get into in really, really flat market. But I think we're entering a market now that is starting to move a little bit. And I think that's probably bringing the swing trading, psychology to the course. I'm looking forward to bringing it to us because I think we can certainly see some examples in the current markets where it's absolutely prevalent to actually play this type of strategy. That's for sure.
Yeah, I'm just 1 second time, just moving over to the proper microphone, just making sure we've got this thing set. If you could just talk to people about the beginning here, just want to go through the things that we're going through today, and then we'll get into it. I'm just making sure the mic's set up.
So what we're going to cover today, we're going to have a very deep understanding of what swing trading concepts and techniques actually are, and really how you can use them to develop a winning strategy and I guess capture those medium to medium to longer term moves without being the absolute scalp mentality where you're looking at getting in and out. So we're looking at that sort of medium type of trading where you can get a decent move out of it. Generally, the 2 to 3 to 1 sort of return is what we're looking for there. Then we're going to learn some of the key setups for swing trades, including the trend continuation pattern, which is going to give you some of the best swing trades, and of course the breakout opportunities, which really gives you a timing advantage. Then we're also going to look at the risk management that is obviously important with all trading, but also with swing trading, because if you don't get risk management completely right with a swing trade, it really plays a lot of havoc with, I guess, your risk reward trades. Really, you need obviously to get a swing trade is not going to be a one-to-one trade like a scalp can be. It's very, very important to have your risk management right because swing trading isn't as frequent. So you definitely need to be getting your 2, 3, 4 to 1 trades in. So we're going to have a look at those, and then we're going to have a Q&A with the team, of course.
All right. Well, just before we get into today's exciting session going through building a momentum strategy and, of course, bringing your questions in for today, I just want to do a quick disclaimer before we get started. We'll see you in just a second. All right. I'm just going to confirm this, Ty. Is my audio sounding a lot better now?
You sound amazing, Tom, as always.
Yeah, it's better than it was. Okay, everybody in the audience is sounding better, yeah? All right, thank you very much for bearing with us there. Don't worry, we'll get into it now and make sure this is good. So without further ado, Ty, we always get asked the same questions time and time again. And one of these questions that I think everybody needs to understand is how do we even build a winning strategy? How do we go about putting through the correct reasons for we want to build, and what's a great foundation? What are some of the best foundations specifically for swing trading? So today we're going to talk about creating the right strategy that's for you. Of course, what time zones do we want to trade swing-based strategies on? What do we want to start with as a strong base? What are some of the techniques that we usually use and we see mostly used in the industry? And then, of course, how are we going to begin adding confluence indicators to our swing trading strategy? Well, to start off with, we always want to say which time slot is best for you. Now, when you're talking about swing, we're talking about a much higher time frame, aren't we, Ty? We're talking about, generally speaking, around the 4-hour into the daily time frame. These are the best time frames. And I like to also focus on the 2-hour and the 1 hour. And then we use smaller time frames to actually basically scalp our way into the entry. So generally, we make our decisions based more on a 4-hour, 2-hour daily time frame. And then we make our kind of like scalp-like entries on the smaller time frames. So in general, if I was to say what's the best time to actually come in and have a look for a swing trade, it's often the close of the session, the end of the US session and the beginning of the next session. We can make decisions. We can look at our indicators. We can look at all our confluence techniques. Would you say that's your favorite time for swing trading entries, Ty, in terms of making decisions about the day?
Absolutely, identifying the opportunities that you can't go wrong with the daily closes. It's one of the ones that really gives you, especially once the US closes, a lot of candles are based around the US close. And by that time, you've had the 3 major markets around the world all have their say in where that particular instrument is moving. So I think The close of the candle is one of the ones that's most studied right throughout technical analysis. Even the biggest funds in the world often look at the closing candle. So it's a really, really good place to start to identify the opportunities, and it gives you a very, very good indicator of what's actually happening. So the 4 hour as well, love the 4 hour candle. Look, I don't know whether it's because it's coming from our old MT4 platforms, Tom, where 4 hour was just a standard and you couldn't really change it up. But look, in truth, I love the 4 hour because it gives you a very, very good breakdown of every daily candle. Sometimes some of the smaller ones you can get a little bit lost, but in the 4 hour candles, you obviously got 6 candles that make up a particular day period. And in that in those 4 hour candles, you can often see a trend completely reversed in that time, and it tells you a lot about what that daily candle has done. So it's one of my favorite time frames, and it's stuck with us for a long time.
Yeah, so understanding multi-time frame assessment of the market is probably your best thing, is going to be key. But remember, daily and weekly closes for me are very important, because when we're talking about larger traders, we're always talking about the moves. What kind of move does a larger trader do? Well, when a day closes and a market moves above or below that day level, that can either enhance the amount of trades that people need to put in or decrease them. And it's all about scaling in and scaling out when you're a bigger trader. Remember, the biggest traders in the world don't have stop losses. They don't think the same way that necessarily we do as retail traders. Instead, they're increasing and decreasing their positions. So when we're talking about swing trading, Ty, it usually is best to start on the majors. We always talk about these types of things. Gold, all the gold crosses, they're excellent. USD majors, odd USD, Euro USD, USD yen, pound USD, when the trends are going strong, really great. Also would include their dollar index is an excellent one. And then, of course, we've got Euro pound, Euro yen, and pound odd. These are ones that are always great as well. Some like a little bit of more the exotic major crosses. And then, of course, all major indices. We've got some examples later on in today's videos where we talk about the S&P 500, NASDAQ, and of course the DAX as well. So when we're building a base for swing trading, Ty, it's always about the 2 steps forward, 1 step back technique. And that generally is that we're seeing a series of either higher peaks and higher troughs, or higher highs and higher lows in an uptrend, and lower lows and lower highs in a downtrend. It's our job as a swing trader to recognize the beginning of this, what we call the lightning bolt. Now, the lightning bolt, Tyron will break it down for us in a second, but it's basically the beginning of what we call a swing trend, isn't it? It's that low into high, into higher low, into higher high. Can you break down why this is so important for us today, Ty?
Absolutely. Look, one of the most important parts of trading, and if you ask us at any time in our trading journey, which is the most important indicator that you can look at if you could only use one, it would be price action itself, because it's the only one that's actually a leading indicator. So when we get patterns like a series of higher highs and higher lows in whatever time frame that you're looking at, it's all relative, of course, that's giving us the idea that the momentum is actually in the favor of where you're going. Look, you've got to remember that the best trends always pull back. What you don't want to see is a runaway market where the highs are far away from the lows and you see big extreme moves. Although that might be really cool if you've actually jumped in at the bottom and you've ridden that wave. For the most part, we're traders, right? So what we're looking for is an opportunity for replication, and replication is never better than when you're seeing a series of higher highs and higher lows, or lower highs and lower lows in a downtrend, playing a very even game. Now, we're going to talk about indicators that will help that down the track, but in reality, the price action is actually all you need. When you start to see those patterns forming, it makes a very, very important pattern of momentum for you to actually understand the market is moving in the direction that you need it to be moving.
What we're looking for as well is the beginning of a breakout. So often markets will stay in some type of range bound area. We often talk about this particular chart here as the way a market might build an accumulation base. It comes down and it starts to kind of build a base situation. Then all of a sudden we see the lightning bolt as it breaks out and starts moving forward. That means that we've broken out of a range and we could be entering into what we call a swing trading market. Markets will sit around 5 months of the year generally in range-bound activity, and around the rest of the time, 7-ish months of the year, in trending or swing entries. Now, Tyrone mentioned a very important point before, that we've seen an increase in the VIX, which is the volatility index, and that we've also seen an increase in market movement recently because we've broken out of a range. This is the best friend of a swing trader. So when we do a break to the upside or we do a break to the downside, it makes us start to think about pullbacks and getting into these types of entries. So, of course, what are we trying to do? Well, as a swing trader, some of the best confluence techniques that we can use is to understand channel patterns and patterns in general. And the reason we might want to do this is just an example of how maybe some of the patterns in an uptrend we might want to use could look like. We're basically looking at the idea that if a market is swinging, that is, it's pulling back, how could we better enter into the pullback? One of the ways we can do that is by going to the smaller time frames. Imagine, just for example, this was a day chart. And the day chart had started and it's gone low into a high, into a higher low, into a higher high, and then it's pulled back for a potentially higher low. This is a day chart, remember. As it comes down to this circular zone, it does this. Now, Tyron, how strong would that type of position be with a pullback based on a breakout of potentially a nice accumulation zone previously, and then we get a double bottom happening on the smaller time frames, such as maybe a 1 hour time frame slot? Would that be something you'd look at significantly?
Yep. Oh, absolutely. And look, that's one of the probably hidden myths of patterns, actually. Like, I know double tops and double bottoms are generally regarded as reversal patterns, but it really comes down to how you use them. When you are looking at a bigger, longer prevailing trend, like we mentioned earlier, when we're looking at multi-time frame analysis, and then we get a double bottom in the direction of the prevailing trend, it's so much more powerful than actually just a double bottom or a double top. It's actually trying to reverse a trend. Remember the old adage that trend is your friend. It's always true, even if you are trading a sideways market or one that's just broken out with a pattern that would generally be regarded by, I guess, the people who trade the absolute classic patterns as a reversal, when you are trading in the direction of the trend. So you say, in other words, like Thomas mentioned, if we've got an uptrend and we see a pullback, and on that pullback in the smaller time frame, we see a double bottom in the direction of the bigger trend, say on a 4 hour or a daily, that adds so much more weight to that pattern to make it far more relevant. And you've got to remember, all of these patterns that we're talking about here, we've got head and shoulders, we've got flags, we've got triangles, all of them are telling you a story. It's not some magical thing. You've got to remember the price action inside these patterns is actually telling you a story about what the market is actually doing. And that's why price is so important. Don't forget, price makes up every pattern. So it's not just the pattern that you're trading, it's actually the price action inside it, which is actually important.
Now, another big thing to do with really any type of swing trading method or day trading method here for swing is that we need to understand also the basics of support and resistance. Now, we're going to assume that most people know that resistance is a level where markets basically have hit and they've rejected. Sellers have effectively taken control. As we break through that, we then move to potentially a new level. But basically, markets remember their previous history. And in this case, the resistance can become what we call support in the future. Now, this is important because it's starting to build a complement stacking technique. We not only know right now some of the times that we want to be looking at, day trade close, so the daily close, the weekly close, the 4 hour charts. But what if a 4 hour or daily close closes above a key resistance? Maybe it's a 1, 2, 3, 4 previous resistance touches, something like this. And then it comes back down to this level. Not only is that a swing because the market's coming back down, but then it does something on the smaller time frames that might be, as Tyrone mentioned before, an inverse head and shoulders here, or a double bottom, or any of those things. All of a sudden, we're stacking the odds in our favor, aren't we, Tyrone? And this is what is beginning a great beginning for a swing trading method. In fact, it was one of the first ones we ever created to realistically start to gain edge in markets, was something based very closely to this.
Yeah, and if it's the only one that you study and follow, you are not going to go too far wrong. There's a lot of very, very powerful professional traders who only use this method and are very, very successful at their craft because they understand and find these in the markets all the time. Like you don't have to hunt very hard to actually find these really, really important zones. And if they're the only things that you trade and you want to master that, that would be a very, very powerful strategy in itself.
So here's just an example of a market where it's broken through a 1, 2, 3, 4 resistance. And then, of course, it's done what we call role reversal. It's come back here. Now, whether you're a supply demand trader, a support resistance trader, or anybody else that's thinking about this chart, what you can often see here is the market is basically creating what we call a channel pattern above that previous resistance. Effectively, it's accumulating a position. And as it breaks out, you would have a pretty big smiley face here. It's in the direction of the overall trend. It's in the direction of the higher highs and the higher troughs. And of course, this would be an excellent style swing trade entry. Some other examples here would have been, of course, the market moves up, The market comes down, does a small double bottom here. That would be an excellent entry. The market breaks up. The market comes down, does an inverse head and shoulders. That would be an excellent entry. These are just two things that you can stack together. But of course, there are even more things that we can stack together, Ty. And that brings us to, of course, understanding what swing-based strategies could also include. One of our favorites is always going to be moving averages. Then we've got Bollinger Bands. We've got volume profiles we could use for take profit levels. We've got Fibonacci indicator, which we'll talk about soon, RSI indicators, and of course, pattern analysis as well. So these are just some of the ways that you can build a better swing trading confluence from the base up using price action, pattern analysis, role reversal from support resistance, and possibly even bringing in a little bit of supply demand as well. It helps us to think about 2 steps forward, 1 step back, and using some of the previous history of the charts. So Tyrone, it's not just about building a winning strategy that we're looking at today. It's going to be what are the best indicators for building a swing strategy. And of course, one of our favorite indicators that we talk about all the time has to be moving averages. We use it in a couple of different ways for swing trading strategies, so stick around. And of course, this is one of the most basic but effective ways of using moving averages. We'll use some real examples here today of how things might look. And of course, we'll talk about which are the best moving averages to use for swing traders. What tends to help us the most? Again, which timeframes should we be using them on? Now, Ty, you love moving averages, don't you? I think you're probably even more of a fan of them than I am. Go through here just for everybody. Look, I like them as well. Don't get me wrong. But go through why the 20 moving average is probably the most well-used moving average. Can we just break it down to some common sense for everyone out there why we might want to use a 20 and what the difference between a 20 SMA and EMA actually is?
Yeah, absolutely. So look, in essence, a 20 moving average in the days prior to the charts working out everything on an algorithm and you were only looking at it and seeing it, charts, technical analysis classic was done actually by hand. So, and the day chart was actually the one that people weren't drawing up 1 minute, 5 minute and 15-minute charts, right? They were going at the end of the day, drawing up their charts on a daily basis, of course. So what a 20 moving average in the classic mode is actually a month's worth of day trading. When you think about it, there's about 20 actual trading days in a month. So it represents the average movement of a month on a daily time frame. Now, of course, with moving averages, when you go to the smaller time frames, it auto-calculates. So although we're talking about daily as a period, it adjusts itself. So if you're on a 15-minute chart, we're talking about the last 20 candles on a 15-minute chart, the last 20 candles on a 1 hour chart. But in classic technical analysis, before we had all of the software, most of the time people were looking at daily charts. So really, when you look at the 20, it was an average of the month, and that really has stuck. And that's basically how it really got its name. Now, even it's a mean reversion MA mainly because of that reason. Also, a lot of indicators are actually based on the 20 moving average. So, for instance, if you're using a Bollinger Band, the middle band of the Bollinger is the 20 moving average. So, if you put a Bollinger Band over a 20 moving average, you won't actually see the 20 moving average. So, very, very important to understand the difference between the two moving averages that we really look at, which is the simple moving average and the exponential moving average. So the simple moving average is just simply the calculation of the last X amount of candles. So if we're looking at a 10 moving average, it's the last 10 candles added up and divided by 10. If that was 20, if it's the last 20 candles, then divided by 20. The exponential moving average is a little bit different because it's more weighted to the front end. So what that means, more calculation is based on the last few candles that have passed rather than the say candles 8, 9, and 10 on a 10 moving average. The reason why this is important is because it makes this moving average a little bit faster. So it's a little bit more reactive to price in the current market. So when we look at that chart, we'll pop that chart back on that we had previously there. When you see the 20 moving average, SMA and EMA, you can see that the blue one is faster than the red one because the EMA reacts more quickly to recent price action because it's got more weight based on it. And it's actually very, very important. The disadvantage there, of course, is sometimes it can give you a false signal or a false breakout a little bit more quickly because it is reacting faster, especially in a fast-moving market. But generally speaking, that is our favorite for the 20.
All right, well, let's have a look now at moving average crosses. So, of course, we talked about exponential and simple moving averages. In general, we're going to want to use exponential moving averages on the fastest ones. So let's say we were selecting some of our favorites, which would always be 20, 50, 100, and then 200. you could make an argument that the 20 and the 50 should be most likely exponential moving averages because they need to be more in touch with current price. And possibly the 100 could be an exponential or a simple moving average, so either or. And then the 200 would generally be a simple moving average. And the reason why is because these would be more likely to be smooth. Like 200's a lot of periods. We don't really need too much extra,
No.
push on the last couple of candles, do we, Ty? And of
No,
course,
not at all.
as you put these on the charts, they'll change to each one of the timeframes, as Tyron mentioned. So what about moving average crosses? Well, this is one of the techniques that we could use. And of course, for swing traders, what it can often be is that it's a bit of a signal that we're breaking out and we're actually entering into a new trend. So a lot of people like things like the 20 and 50 exponential. As the 20 crosses the 50 exponential, that's considered potentially an upward trend on the 4-hour time frame. Now, I've got a little bit of a hack, and my hack is generally if price action goes above a 200 SMA on the daily, that often means that we're in an uptrend. And if it goes below, it often means we're in a downtrend. Now, that's a little bit of a hack to try to define trend for swing traders. There are obviously better price action based moves, but that's something I found to be relatively effective. What do you think about that one, Ty?
Yeah, I think it generally definitely gives you a consensus. What people struggle with quite often is actually trying to determine where the trend actually is. Is it in an uptrend? Is it in a downtrend? I think having hacks like that, especially on a time frame that you're familiar with, is important because you know what the overall market is doing without really putting too much thought. You don't want to be in an analysis paralysis position where you can't quite work out whether it's actually in an uptrend or a downtrend. You do need defining levels where you can say, all right, we're calculated as an uptrend or a downtrend very, very simply, because then it gives you a broad mindset as to how to actually identify the opportunities in that direction rather than trying to actually work out what the direction actually is.
And we want to make quick decisions, fast.
100%.
So sometimes when you look at a chart and you're looking at maybe 20, 30, 40, 50 charts a day, especially if you're swing trading, you might need to be able to quickly say, is this an uptrend? Is this a downtrend? Make those decisions quickly. So, Ty, my favorite way of activating swing trading methods with moving averages has to be dynamic support and resistance. And this is where we get those series of higher peaks and higher troughs. And what actually happens is we get consistent pullbacks. Now, you've heard us probably talk about this on the channel before, the 1, 2, 3 system. Now, what it means is that if we get a breakout and we start to enter what we believe is a swing method, that is, we get a single touch, we get a double touch of a particular indicator, being the moving average. This is a 50 SMA in this case. And then we keep making a series of high peaks and high troughs. As we come back, because we've had 1, we've had 2, it kind of becomes a self-fulfilling prophecy. 3, 4, potentially 5, 6, 7, 8. Could keep going for a long time, couldn't it, Ty? And I've seen these go upwards of 15, 16 times where it's touched the same moving average on the way up through a swing trade. And basically given so many opportunities. And it's all good until it breaks back below. And that, of course, tells us to wait, say, push the brakes. Let's hold back a little bit here. We're going to wait until now we see another signal. And that kind of helps us to make better decisions. How often do we see it? Quite a lot. Here's an example recently of the S&P 500. Now, I've got an updated slide for this just to show how another stock has done something like this. We see a breakout. This enters into what we could be perceiving to be a swing method because, of course, we've got an upward trend already coming through. We've now made a series of a new higher peak, and we basically come back 1 time, make a higher peak, come back 2 times, make a higher peak, come back 3 times, or maybe that's a good purchase zone. Maybe we can build some confluence around that. Again, the moving average gets us into this aggressive trend. Makes a new peak, comes back again. Another entry. Makes a new peak, comes back again. Potentially you place another entry. However, there have been some signs of weakness here in certain markets. And here's an example of weakness starting to appear. In the S&P, I think you probably would have tried to go for that entry if you had other confluence reasons, Ty. But in this one, we certainly wouldn't have. Here's the first breakout, the new peak, number 1. Number 2, new high. Number 3, enter in. Number 4, enter in. Number 5, enter in. Now, what it does here is makes a higher peak and it comes back. Number 6, enter in. Then it doesn't make a higher peak. How important is that when it doesn't make a higher peak, Ty? swing trader.
Extraordinarily important, because really what that's shown you is that trend is starting to weaken and you need to be on high alert. Now, you've got to remember that it doesn't mean that trend is over. It just means that you have to be on high alert. And these are the nuances of actually understanding the market, because for those of you out there thinking, well, it can't be that easy that you can just be looking at pullbacks to a moving average and just trading in that direction. But in a sense, trading can be that easy if you're looking at it from a longer term view and you are just simply swing trading a big long prevailing trend that you know is in place. It can be actually as simple as just trading that. Where it gets technical and where you can really hone in your skills is actually identifying and working inside those zones. So when you get that pullback to a 20 moving average, you start to really analyze price action on a smaller time frame to look for those reversals. Now, this is one of them where, as you can see, it made a lower peak, and that straight away puts us on high alert, because guess what? There's a chance that that higher high, higher low sequence is going to end. And if we get a changeover where we start to see a lower high and lower low, that really has reversed the prevailing trend. So we're certainly not going to be placing long trades in that direction once we've got a big warning sign. It's like approaching the traffic lights and they turn yellow. Do you really hit the gas? Or do you actually just back off and say, all right, we need to slow down here? And that's basically what it is. You can't just trade to your heart's content and hope that's going to go along. You need to understand when the market is trying to give you a signal that there's potential weakness. Now, it could turn around and go long again, but when it does that, then you've got your side that momentum is continued. But when you see a warning light, it's definitely time to stop and take check.
So in this example, we got a warning light, then we close below, and then you can see what happened the next day. Bang, straight down, and has basically continued selling since that point. Now it's come to a pretty important accumulation zone or a pretty important support zone. So you can see why maybe there initially some rally buyers will come in. The thing here is, though, that's a large percentage of drop. So to know trend had changed was really this candle here, and the evidence being the lower peak behind it. And that's something that a lot of people don't use. That's something that's great for a beginner out there and a really top tip when we're talking about moving averages today. So what are some other examples of confluence indicators we could use for a swing-based building system, and in terms of using moving averages and, of course, other indicators? Well, I think some indicators that we could add together would be moving averages, 20 EMA, 50 EMA, 100 or 200 SMA, 100 SMA, or EMA, or 200 SMA, and then, of course, Bollinger Bands, which are excellent for just seeing whether a swing-based trend is maybe getting a little bit extended or pulling back to a nice 20 moving average, which is the middle of a Bollinger Band default. And then we've got Fibonacci indicators, which can be stacked on top, and, of course, RSI as well can be a helpful indicator to use. So, Ty, how do trends even start in terms of swing, and how do they swing particularly? Well, this is a question we always get asked. Okay, great. Maybe we can use moving averages to pick up a swing trend. Yeah, you certainly could. Maybe we could use patterns to pick up a swing trend. Absolutely, we could. And we could start to build a series of high peaks and high troughs on the market. And we could say, okay, we've got a moving average behind. That's good. And maybe we even have a double bottom behind. Well, that's excellent. But is there another little indicator that we could use on the charts? Well, luckily, I believe there is. And this is one of my favorites, which is, of course, the Fibonacci indicator. Pretty much everybody uses one of these, don't they, Ty? And it's a basic yet effective thing that we can see on charts. And it's what I would like to think of as human psychology represented on a chart. And it kind of follows a lot of those reasonings. So do you want to walk us past why Fib is so important, where it was discovered, why beginners need to pay attention to this one as well?
Absolutely. And a lot of you, even if you haven't got a trading background, you may have heard of Fibonacci numbers in everything. They're geometrical shapes, the pyramids, everything falls back to a Fibonacci number. And it was basically invented or found by an Italian mathematician named Leonardo Fibonacci. No real surprise there.
Egyptians, guys.
Yeah. So actually, we need a picture of Leonardo Fibonacci instead of the normal one that we show. But look, it is effectively, Fibonacci numbers are best described as a sequence of numbers where each successive number is the sum of the two previous numbers. And we'll show you an example how that actually works out. But it actually, in theory, it can go to infinity, where you've got the 1, 3, 5, 8, 13. So every time, all you need to do, you can see as it adds up, all you do is add up the two numbers previous, and that is what your next number is. And that can go all the way to infinity. Now, the golden ratio is 1.618. Now, really, that comes back and is tied to the fact that each number of the Fibonacci sequence is actually 1.618 times the previous number. That's why it's called the golden ratio. So 3 is 1.618 times of what 2 is, or very, very close to. That's what the ratio is. And it starts from 1, and it does technically go to infinity. So the important Fibonacci numbers, of course, that we follow are the ones that are going to be more relative to what we see on a chart. But when we look at it as an example, you can see here, you draw a swing low and a swing high. So you basically draw your levels for the Fibonacci. And what that does, it produces, by default on most platforms, a series of Fibonacci numbers that are designed inside the platform. Now, you can change these up, but we don't recommend that you do so because, of course, the only thing that makes these numbers powerful is the fact that everybody's looking at the same numbers, right? So you don't want to be just creating your own, otherwise it doesn't really mean anything. But the most important Fibonacci numbers that we believe work the best are the 38.2 fib, the 50 fib, and the 61.8 fib. Now, they are effectively percentage moves of the measurement that we've just taken. So if we've got a 100-point move, a 38.2 pullback is effectively 38 pips from the high. A 50 is half of that distance. These are the important ones that we find work very, very well because they're the most significant for people who are actually trading just Fibonacci. Now, in no way do we ever recommend that Fibonacci is the only thing that you should do, because if they're the only things that you're following, you're putting yourself at a big disadvantage. But they're an extraordinarily powerful resource when you have the backing of other indicators in the market, whether that be swings or support or resistance or other moving averages or other indicators. Used as part of a strategy, these are extraordinarily important and give you a very, very big edge as opposed to just trading Fibonacci numbers alone.
Yeah, so Fibonacci is a great way of recognizing a pullback. Before we had a chart on, and we basically saw here that we had swing low to swing high. Well, this is, of course, a trough into a peak, into a higher trough, into a higher peak. Now, why that's important is because if markets are pulling back, let's say it's 2 steps forward, 1 step back, which would be the 50, we might then see a double bottom pattern. We might see an inverse head and shoulders pattern. We might have something like an indicator such as the moving average behind it. We also could have previous resistance becoming support, such as it is here on the 61.8. And if we saw an inverse head and shoulders, double bottom, and moving average there, I can tell you that being in the direction of the overall trend would be an incredibly compelling storyline. So remember, when it comes to using Fibonacci, it's also about thinking about time frames. What time frame should I be using this Fibonacci on? In general, I would be pulling from the left to the right on things like 2-hour charts and 4-hour charts as a swing trader, and even dailies. And I think these are the best timeframes for us to use our fib, but don't use it by itself. Always use it with confluence of other things. It's like when you think about a market being sideways for quite a period of time. Is Fibonacci the best to use in this area? Well, maybe not, because we're in a very tight, compressed zone. But as we break out and we enter into a new swing-based system, which we can then use 7 months of the year, then basically on average, something around there is how often we trend, then we can then say, okay, well, as the market pulls back to a 38.2, a 50, a 61.8, or a 75, or something like those fibs, we might be looking at finding another pattern, another moving average, or even possibly the back of a Bollinger, such as a standard deviation 2 times on a Bollinger. That would be a phenomenal 1, 2, 3 type of setup, wouldn't it, Ty?
Yeah, most definitely. It is really understanding. It goes back to understanding the market that you're in. If you are in a trending strategy and you're placing a trending strategy in a trending market, a Fibonacci is an awesome tool to use. But if you identify a flat market that's not really swinging in the ebbs and flows that you want from a trending market, a Fibonacci is not going to do you much good, because the problem with the Fibonacci tool, it is a subjective tool. I mean, look, you can technically draw a Fibonacci expansion on any chart, really, but if you're the only one seeing it, is it really going to be beneficial for you? And that's why, identifying a good trending market and using the right highs to lows is key to it, because really what makes it a self-fulfilling prophecy is the fact that it's being overlaid and being traded by thousands of traders out there seeing the exact same signal. So it's very, very important to understand which market you're trading, and when you do isolate that, then you can use it for the pullback. Pullbacks is probably its biggest benefit. It's one of my favorite ways of using Fibonacci, using it to isolate the most important pullback in a trending market, and that goes for a downtrend and an uptrend, of course.
So Ty and I have put together some of our favorites here. I'm going to go with first one, golden pocket. What a golden pocket is between the 61.8 and the 66, which is actually a GAN number or GAN number. And basically, I like that little slither. It kind of creates a level of, I believe, demand or supply, depending on whether it's, of course, a sell-off market or a buying market for swing. My favorite is going to be the golden pocket. Now, Ty, I'm going to assume you're going to say 38.2, but why do you like the 38.2 so much?
I love the 38.2 because what that really indicates is that really gives the true 2 steps forward, 1 step back approach. Why I like the 38.2 so much is because a market doesn't lose much momentum to hit the 38.2 and then pick up momentum from there. The deeper the pullback, sometimes there can be obstacles in front of it to only even reach the previous high. So a 38.2 is the optimal pullback for me in a trending market, because that's how I like a trend. That's how I like my lightning bolts, really, Tom. The lightning bolts, when they're a 38.2 pullback on the bottom of the lightning bolt, that's exactly where I'm really comfortable, because I know there's a very, very strong amount of momentum helping push that market up, and hasn't got a lot of work to do to make a new high, which really fulfills what we're looking for in a lightning bolt.
Yeah, oftentimes as well, if you've been watching a swing trend and it's done a 38.2 before, it will often do a 38.2
Yeah.
again. And this is actually based on a theory such as Elliott wave and a few others. You'll often see replication occur on markets. So it's another bit of a top tip when you're starting to use Fibonacci for your swing trading confluence systems. So, Ty, today we've talked about the idea of building a strategy and bringing it onto a chart. And then, of course, understanding that we're using price action, we're using support resistance, we're potentially using pattern analysis, moving averages, maybe Fibonacci. And of course, we talked about all these other ones that we could be using. Let's have a look at the charts, though, now, and kind of discuss some of the things or some of the ways that we could have gotten into some of these recent trades. Now, Apple is a clear one we already talked about on the charts. In this case, it would be as the market's pulling back to these moving averages, especially because we saw a 1 and a higher peak and a 2 and a higher peak, then as it comes back down, we might be looking at the smaller time frame. So let's say we looked at something like this level here, we would actually be breaking that down, and we would say, okay, well, how does this look on a 15-minute chart, on a 1-hour chart? This is something that we'd be looking at on the markets. And be looking for patterns coming off that level. So because we know that's a 20 moving average, we could then go into the charts and say, do we see any strong signals that are telling us that maybe the trend's turning around? And the reason I want to bring this up is because there is a little other hint that I really like. And I say, don't necessarily buy the dip, but instead buy the V. And what that means is that as the market's coming down, you're always going to feel like getting the best price. And that means we want to pull that trigger time. We want to get in because you think, oh,
yeah.
it hits support. It hits support. That's a good one. It hits support and it's hit my 20 moving average. I'm going to buy it. Sometimes that will work, but more often than not, we all know the way it goes right down and it hurts us. And it sounds like that may have happened to one of the people in the class here today, or which is Let's Go. Sounds like that unfortunately may have happened to you. And don't worry, it's happened to so many out there that are watching. So instead, what we could be looking at is we could say, okay, well, here's a low. Here's an equal low. This is, of course, support. This is the moving average. What we're going to do is as it breaks through this resistance, we're going to buy the market. Because what that is telling us is it's kind of like buying a double bottom pattern. And in some ways, this is actually a double bottom pattern. It breaks through and it tells us that we are moving forward. That's effectively the V. And you're actually much better off to buy the right-hand side of the V than the left-hand side of the V, Ty, especially in swing trades, because as the market moves up, you're getting that momentum, that slingshot method. All of those things are starting to appear onto the charts. So I think that's a bit of a top tip today. If you're going to start trading swing, maybe instead of buying the perfect dip, you should be buying the V as you're seeing those confluence factors actually coming in. And you know the best thing about the V, Ty, it's when you've got the V, you technically know where your stop loss is going to be.
Absolutely.
Maybe I should put that on a shirt.
Yeah. And I think it really comes down to our mantra, and it's all over our charts. It's the patience, react, don't predict. And really having the patience to wait for that market to actually bounce off that support, create the V, really puts momentum in your favor. What you're really essentially doing there is allowing the market to actually come and test that level and then change its momentum around. So while you're getting, sure, you might give away a few pips while you're waiting for that V to form, but that's made up more than by actually getting those pips, by having momentum on your side, proven momentum that's actually changed the direction and is trading in a particular. So yes, you are giving a little bit away, but also that's going to save you 9 times out of 10 because you've got momentum on your side, rather than having that V turn into a very big, large, downward sized lightning bolt.
Yeah, Let's Go Today says that patience is hard to master. Yeah, that's why we have this slogan up here: patience, react, don't predict. Pretty much 90% of people are going to find it hard in markets due to their lack of patience because they want to get in. Another big problem is often that people are then told by other people, oh, it's so easy. Oh, did you see how much I made today? Did I do this? I do that. You've got to stay in your own lane sometimes in life, and chasing things is often the wrong thing, the wrong way of doing stuff. It's not a problem necessarily not getting the low. It's a problem missing out on the 2/3 of the market move.
Yeah,
and do remember, this is what most top investors get. They look for 2/3 of the move, and they look for the evidence on the charts that forces them to say, I've got enough reasons to go in. It's not my opinion anymore, because opinions are kind of useless. It's evidence that we have on the chart.
Yeah.
If people don't mention statistics and they're not building evidence in their technical analysis and fundamentals and everything else that they're doing, Ty, it's highly likely they haven't got a replicatable system. And that's something you mentioned in today's live session. So for beginners out there, I think the biggest takeaway for today is not only to build confidence with quality stuff, but to also build a replicatable system. And I'm going to say this: you need 40 reps. And until you've taken 40 reps, this is pretty much a proven psychological thing. It's unlikely you know your stats or you know whether your system is profitable or not. That means you have to take the same thing 40 times, because most of us tend to stop somewhere between 8 and 14. And when I found out about that, Ty, I was very interested. And I thought back to where I started and where you started and where all of us did and how many people we've trained and all these things. And I would agree with that. Because after someone takes about 2 or 3 losses in a row, they tend to throw it out the door. You have to get around 40 reps of the same replicable system in.
Yeah. Remember, you don't want to be listening to the noise of people talking about how much pips they've made. Generally, if they're talking about it, they probably haven't got, because they're so excited about it, they haven't actually got a replicable system. If you have a system that you follow and that works, there's no need to tell the world how good a trader you are, because what you're doing is just normal. You haven't actually done anything that's actually out of the ordinary. You've done something that's actually within the expectation of your system, and there's no need to brag about that. When people are talking about how much they've made on this and how much they've made on that, you can probably generally assume that they haven't got a replicatable system that they can follow, because they have to talk about it because they're so excited, Tom. So you don't need to be excited by winning trades. The winning trades is part of what you actually do when you've got a system that's actually replicable.
That is exactly right. We've got some good questions coming in, Ty, so I'm going to answer these 2 to finish off the show here today. Avery says here, what do you suggest if we enter as you were talking about today, but then trend does the opposite? Will we move stop loss to wait it out, or for the next several days? Absolutely not. We will live and die by the sword there, Avery. Look, about getting the reps in is also about understanding that pulling the trigger or getting into the trade is not necessarily that hard. Entry is not hard, but knowing where you're going to place your stop loss, knowing where you're going to place your take profit is probably the art of it all.
Taking losses is part of trading, and you have to be able to take a loss. Because that turns into an absolute, chicken soup, Tom. We've seen it happen. That's why there is one rule: you can absolutely move a stop loss in the direction of your trade, and by that we mean cutting down your potential loss, or breaking even, or locking in profits. Never the other way around, ever. The stop loss is the only mechanism you've got to really practice correct risk management. Okay, so just always be mindful of that. Don't wait for a rainy day. Take the loss, and if it's there, because a stop loss should be where that trade has actually failed. Okay, it's not a case of I hope it should hold up. The stop loss needs to be in the correct place, where if it gets hit, that trade idea that you had is no longer a valid one. Okay, so just remember that as part of the rule. It's your only mechanism of correct risk management.
So I'll just give an example here for stop losses, Ty, because a lot of people will say, well, I lose my stop loss, then it goes off in the right direction. So an example here is the S&P 500 coming back down to the weekly 20 moving average, which is, by the way, called mean reversion. It happened literally last week on the S&P 500 here on the Pepperstone platform. TradingView, by the way, if you're interested in getting yours attached to it. And a normal kind of buy the dip style person is going to say 20 moving average hit, support hit, buy. The problem with that trade is that where you're going to put your stop loss. And you might say, well, it's simple. I'm going to put it below here. In this case, or below the 20. In this case, it held. But what if it did this? What if it came down, you bought, you put a stop loss here, it took the low, then it V-shaped. The issue with that is that you haven't waited for the evidence to show that even a buyer is even present and wants to pick this up in the direction of trend. So what you instead should have probably been looking at doing is going to the smaller timeframes and saying, okay, well, here we have a series of lows, and we've got lower high, and we have a lower low, and then we have a lower high, and then we have a lower low. By the way, Ty, I think these phones just listen in way too much. These series are getting wild. Tried to make a call then. Anyway, we've got a lower low off a lower high. I don't even know who that person was who was trying to call. And then we have here a higher high. Now, because we break the sequence, in essence, that's the V. Now, the key here is what happens. The V happens off the level that we believe it should have. We have a choice then. Put a stop loss below here or put a stop loss just below that previous low. At least we give ourselves the evidence in hand. And that's that final step of patience. And I think it's a great beginner lesson here that we've done today. I hope you've enjoyed it over here on Pepperstone. If you have, give it a big thumbs up. If you like this type of content, let Pepperstone know. Put it in the comments down below. And, I'm excited to do next week as well. Remember, we do next week, 8 p.m. Australian Eastern Standard Time. It'll show up on YouTube as whichever time zone you're in. But we hope that you've been enjoying these. And if you have, let us know in the chat as well. It does help us out just to know we're doing the right stuff for you guys. Ty, do you have any leaving comments here? I think it's a good one.
Yep, I think it's been a really, really good lesson. I wish that we had the resources that you traders have got now back in 2007 and 8 when we first started, Tom, because, all these lessons we had to learn the hard way, unfortunately. It would have made our journey a lot easier because, believe me, the things that we've talked about today can drastically improve your trading if you've had issues in the past. These are replicable things that you can actually place in any instrument. It doesn't matter whether it's currency, whether it's the indices, CFDs, whatever you want to trade, you can apply these principles and they all are very, very effective. Okay, so these are used in the real world. This is not just theoretical ideas. This is used in the real world and it plays out time and time again. So be sure to watch the replays of these if you've missed any of it and you didn't understand it, because they are all very, very important concepts. Or they may seem aimed at a beginner level. You would be surprised how many people actually just trade these methods alone and are extraordinarily successful traders.
All right. From all of us here at Pepperstone, thank you so much for watching. We hope you enjoyed. We'll leave you with a quick outro and we'll see you next time. Bye for now.
Thanks, everyone.